Talk to me about this. Talk to me about this new push into dividend investing by Gen Z investors. In your mind, are they doing it right with these leverage ETFs, these options, and et cetera?
I think some of them are and some of them aren't. And I had a very interesting conversation last week with a guy named Eli Brees, who runs a website called Dividendology. And he's trying to give that Gen Z group guidance to say, be very, very careful about the highly leveraged dividend ETFs, where you look at it and you're like, wow, I'm getting 9%, this is incredible. But the reality is it's super high risk, there's tons of leverage, it's working off of securities that aren't dividend oriented at all. And a lot of these funds are self-depleting. So this guy Eli's mission is to go out there to this Gen Z crowd and say, like, hey, be careful, maybe go a little more old school. So he didn't say this, I'm saying this, but if you look at funds like from the Hartford funds or Wisdom Tree or Hamlin, those kinds of funds are more old school and have real dividend companies where the company is growing and the dividends are growing and they pay out consistently. They may not offer those juicy 9% kind of clickbaity yields, but they'll sustain far better in, for the long run and return a growing income stream. So the Gen Zers like this, which completely makes sense, right? Because dividends, in theory, are a part of your portfolio that are a pretty assured return. And the Gen Zers have grown up in a world where the market's been insane, nothing's assured. Some of them used to have high-paying jobs and don't anymore, so they're looking for ways to supplement their income, but they need to be very careful and a lot more thoughtful than I think some of them are being. Okay, what's being careful? You and I, we've talked about dividend strategies many times on this show and other shows here on the network. I know one of the things that I've heard you talk about before are companies that consistently grow their dividends. Some people call them dividend aristocrats. In your mind, is that the right way, or is that too old school and just too, I guess, slow when it comes to returns? I don't think so. I think the concept of dividend aristocrat is the right way to look at it. So if you look at the dividend aristocrats collectively, they're actually not high dividend income. On average, the yield of the dividend aristocrats is just shy of 2%, so more like a market return. But conceptually, what you have is a list of companies that have grown and paid a dividend for over 25 years. So that's what you want to look for. You want to look for that real consistency. But if you need income, then you need to find the subset of those companies or broaden your lens, and they don't have to be dividend aristocrats to still have a high dividend yield. And so what goes for stocks also goes for funds. So you can look at funds and look at the very long-term history of funds and say, like, hey, how did this do during 2008, 2009? Did the dividend of this fund continue to pay out? You can do the same thing for stocks. Did the dividend continue to pay out in through 2008, 2009? Did it continue to pay out through the pandemic? So you really have to do your research. And I think that dividend investing lends itself to active management more than many other strategies, because it's not just checking the box of, have they paid? You really need to get into the philosophy from management of the company or the fund manager to say, is the goal to return capital to the shareholder in the form of dividends and have additional capital appreciation over time? So you need to understand that philosophy. That can't be done using a screen. All right, so I think this is one thing a lot of people, when they're talking about dividends sound great. You buy the stock, you know you're going to get this exact return, but then people also want price appreciation when it comes to the stock itself. I'm looking at a company like Verizon. I was just checking the dividend on this one. Dividend's about 6%. But the stock's only up about 9% this year compared to some of the other high flyers you could put your money into. When people are thinking about dividend investing, how do they balance price appreciation of the stock itself compared to the dividend? Yeah, that's always the challenge. So I'll tell you how I do it. My goal is to have, over the long term, when I'm looking at buying a stock, I'm going to say, over the long term, I expect to get an 8 to 10% return. And whether it's 5% from dividend income and 3% from growth, or 3% from income and 5% from growth, that's the goal. But the reason I have that goal is because over the long term, the market's returned 8 to 11%. So if you can take a long-term lens, you can make a more sound decision. The Verizon example is interesting because S&P's up, 11% this year. So if the stock's up 9% plus a 6% yield, you actually have a favorable return there. If you extend the lens on Verizon out longer, depending on your time period, you could be very flat on the share price and have just collected that yield, which isn't terrible either. But you really, in dividend investing, you have to take a long-term approach, because if you think about it, even within 1 year, the income and a lot of the capital appreciation is spread out over 4 quarters. You really need to go to like a 10-year, 20-year, which sounds crazy in the short-term FOMO market that we live in, but you need to take that kind of approach because the dividend income compounds slowly but very consistently.